If you've been wanting to become a profitable trader, then this is the best place to learn how. And by the end of today's lesson, you'll have a better understanding of candlesticks and candlestick patterns. Let's get straight to it.
All right, welcome to AMU, and you guys are going to be learning about candlesticks. So first and foremost, candlesticks are the essence of trading. So you need to learn how to trade candlesticks on all time frames, whether it's the 5-minute, even 1 minute, 15-minute, hourly, daily, weekly. So I will be breaking down all of the candlesticks. So let's get right into it. So first of all, these candlesticks you're looking at represent a certain time period. So whether we're on the 5-minute chart, every candlestick you see, if we're on the 5-minute chart, will be 5 minutes. If we're on the 15-minute chart, every candlestick you see will be 15 minutes, right? So we will be looking at some live candlesticks as well, right? So we're going to be going over what makes a candlestick red or green. So what makes this candlestick green? Let's talk about it. Let's pretend like we're on the 5-minute chart. So if we're on a 5-minute, within 5 minutes, let's just say it opened here at $10, then it went to $7 as the low, right? Then it went to $15, but then it closed at $12, correct? So in order for something to be green, right, the close must be higher than the opening price, right? And the relationship between your open and your close is called your real body, right? And then for a red candlestick, it's the complete opposite. Let's just say it opened here at 12 when it's high as 15, right? And then when it's low at 7 but closed at 10. Same prices, right? That makes it a red candlestick because the close is lower than the opening price. So if we're on a 5-minute chart, you see that when it opens somewhere and it closes higher than the open, right, it will be a green candlestick and the body will be green. And vice versa for the red candlestick. If it closes below the open, right, the body will be red, right? So let's keep going. And outside of the real body are called your shadows or wicks. Now, these are big green and big red candlesticks. Big green candlesticks represent strong buying pressure, and big red candlesticks represent strong selling pressure. So looking at this, I can tell that it opened here when it's low as here, when it's high as this point, but closed here. So for the red candle, for the big red candlestick, right, I can tell that it opened here when it's high as here, when it's low as here, but closed here to make it red. So by looking at these, I can already tell the relationship between the open, close, high, low, and real body. So let's go over what a doji candlestick represents. Dojis represent when the open and close are virtually the same. So within, let's just say within 1 day, right? Or 5 minutes, whatever, right? Whatever time frame you're on, it opened here when it's low as here, when it's high as here, but closed near the open or virtually the same. And same with here. It opened here when it's low as here, but then buyers came back in control to push the prices right near close, right? And right here, it opened here when it's high as here, and then came back to the lows, right? And then right here, right, it opened here when it's high as here, when it's low as here, but closed right near the opening price. So that makes it a doji candlestick. So now we're going to hop into candlestick patterns. So candlestick patterns, personally, I only use them on the daily time frame. That is where I find them the most useful for my entries, right? So for 1 day, right? So you know that the stock market opens from 9:30 to 4 p.m. New York Eastern time, right? So these are the candlestick patterns that we use, and I will be showing you the most high probability candlestick patterns, right? So you do not have to use all of them. In my opinion, you should be using the most high probability ones. And there are only 2 high probability candlesticks that I like to use, and a possible third. And we're about to look at them right next, right? And we're about to look at them next. This is the most high probability candlestick pattern, and this is called your pin bar, right? So you have hammers and then you have pin bars. And what makes these pin bars instead of hammers? So usually stocks will not close at highs, so we can't call them hammers, and stocks will not close at lows. They usually have some type of wick at the end of them, right? So that means we're going to call them pin bars. So pin bars, you need to think of them as a lollipop with a rocket attached to it, because these things, when at supports, will fly, and when they're at resistance, they will sink. So you have to look at them as like a flying lollipop, and I'll explain more. Or you can also look at them as an astronaut bending his knees and then jumping as high as he can from the ground, right? Or from the ceiling, right? Because it's zero gravity, right? So let's look. As you can see, AXP, American Express, there's a pin bar right here at support. So we were to draw an imaginary line going straight across, correct? You will see that this is a high probability setup. Why? Because at one point in time, it was a huge red candlestick, right? And then buyers came back in control to push the prices higher. So if we go all the way back, right? Let's look at the psychology of this thing. At one point in time, this was a downtrend, correct? And then this was a huge red candlestick. And then buyers came back in control to push the prices higher than what the opening price was, and then even pushed a little higher and closed here. That represents a strong sign of reversal, because remember, it was once a red candlestick, and then the bulls came back in control to push the prices higher, and vice versa. Imagine seeing this at the end of an uptrend, right? Where this was once a huge green candlestick, and then sellers came back in control to push the prices lower. And that's what happens, the psychology of it. When you see these bearish pin bars at resistances, that is a huge bearish sign. And when you see these at supports, that is a huge bullish sign. So AMD, right here, as you can see, this was once a resistance, but then it turned into support. And at this support, you see pin bars, right? Especially this one, right? You have a pin bar at support, and look what happens. So once again, this was once a downtrend, and this was once a red candlestick, and then buyers came back in control to push the prices high, pinning it at support, which makes it a pin bar, and which makes the preceding price action fly. Right? So we have our green and we have our red lollipop. Now, me personally, we all prefer the green charm blow pops, but red is okay too, right? So with pin bars, that is the same exact thing. Although we like the green one, the red is fine too. So as you can see right here, pin bars are created equally, right? A red one is also equal to the green one, right? So always remember that. You can use both colored pin bars as a successful setup. And look here too. You have we have just plenty of examples of why pin bars are what they say they are, right? You pin them at support and they fly. And then we have bearish pin bars, a pin bar at resistance, right? And then it comes down. Now, our next high probability candlestick pattern is called your bullish engulfing pattern. So if we're at a downtrend, correct, and you see the body of the second day engulf the first day, that is a huge bullish sign. So if you see a green candlestick engulf a red candlestick, right, the body has to engulf, right? And I will explain that even furthermore. And then here, if you see a huge uptrend and then a huge red candlestick engulf one of the candlesticks of the uptrend, that is a huge bearish sign, correct? So engulfings remind me of Pac-Man, right? You level up when you eat the smaller people, correct? So that is what's going on. Remember, the body has to engulf it, right? So as you can see right here, there was a downtrend on Beyond Meats, right? And what happened? It engulfed it at support, causing the price action to go up. So it's all about psychology. When you, as you can see also, this wicked outside of the real body. Remember, the bodies have to engulf, right? So I say all that to say, pretend like you're eating a spider, right? And you eat the body of a spider, but the legs hang outside of your mouth. That is the equivalent of an engulfing pattern. The body only counts. So you can eat the spider's body and legs can be hanging on the outside of your mouth, but it still counts as an engulfing. So let's look at some more examples, right? We have a downtrend, right? And then we have some type of support, and we have an engulfing pattern right here. And the preceding price action skyrockets upward. Now, I have a secret. Engulfings off the 200 MA are high probability setups that will fly in the near future. So if you ever see engulfings off MAs like the 200, the 21, right, the 50, even the 8, they are high probability setups. So my favorite MAs are the 8, 21, 50, and 200. Engulfing patterns off the 200 are the most high probability. So the higher the time frame, the higher the probability of it bouncing. So the 200 MA has the highest probability of an engulfing pattern bouncing, and then so on and so on, right? Now, on Amazon, as you can see, we're on the daily chart. Remember, I only play candlesticks on the daily chart. We have a resistance here, right? Touch here, touch here, touch here, right? At this level, at this 3360 level, we draw a line straight across, right? And as you can see, we have a bearish engulfing at resistance. And what happens? It comes down, right? Now, bullish Harami patterns. This isn't as high probability as the pin bars and the engulfing patterns, but they also stand to make you decent returns, and you might want to not second guess them. So Harami means pregnant in Japanese, right? Now you might see people call them inside bars, inside days, and that is because so let's just say this is a downtrend, correct? And then you see a smaller one outside of it, right? This is called a Harami, so it's the opposite. Usually the engulfing will be the bigger one, but now the Harami is the smaller one. So during the uptrend, you get a smaller red candlestick that can probably bring the prices lower. So it just shows a slowing of momentum, correct? So, like I said, Harami means pregnant in Japanese. So what exactly does that mean? That means, right, basically a couple was not having a good time, you know, this and that, and then they had a baby, and then everything was right. So that's what I think about when I think of a Harami. Imagine a couple not having a good time, they're fighting, they're fussing, and then the baby brings them together. Now granted, most of you would say kids do not bring people together, but in my scenario, it does. Now, once again, we have an uptrend, and we have a slight downtrend, and then we have a little baby right here, which brings us upward, correct? So when the body is very small, that is like a Harami pattern, or aka an inside day. Now, hot girl summer. What does this mean when I use the term hot girl summer? I'll show you. That represents a bearish around. So imagine a group of women in a Nissan Altima saying, hey, having a good time. She chilling with her homegirls during the summertime, and then she gets pregnant. Hot girl summer over. So it could be the opposite, right? Now, entries. Only enter these patterns 15 cents above highs. So let's just say the high is 100. Your entry will be 100.15, correct? That is for calls. So with engulfing patterns, you will enter 15 cents above highs. So all of these are 15 cents above highs for entry. And for bearish patterns at resistance, your entry will be 15 cents below lows. So if the low is 100, your entry will be 99.85 for puts. So that is a simple way to gauge your entries for either bearish or bullish chart patterns, right?